How do you invest in private companies? This is one of the questions I get asked quite frequently by people, and often people that are trying to understand the difference between investing in a private company or investing in public markets or investing in real estate. Although I'm not here to give you financial advice, I did think it might be helpful to talk through some of the pros and cons of investing in real estate versus public equities versus private companies. Included in the traditional alternative assets category of investing, investing in private companies is often compared to investing in real estate or investing in hedge funds. And so I thought it would be helpful to talk about some of the pros and cons, advantages and disadvantages of investing in these various different asset classes, and especially spend a little bit of time talking about investing in privately held companies. And if you stay to the end of this video, I'm going to give you a tool that you can use to develop a deeper understanding of the various types of ways in which you can invest in private companies. I'm Peter Harris. I'm one of the founding partners of University Growth Fund. Over my career, I've invested in over 100 different companies, both as a venture capitalist and as an angel investor, including companies such as Airbnb, Snapchat, Spotify, Postmates, Poshmark, Carta, Workfront, and a whole bunch of others. In addition, I've also recruited, trained, and mentored over 400 students and helped them place in some of the most prestigious and exclusive opportunities in the world of high finance, whether it's working at venture funds, private equity funds, hedge funds, real estate funds, investment banking, starting their own companies and raising venture money, all kinds of areas related to venture investing and high finance. But before I talk about privately held companies, I think it's worthwhile to spend some time talking about both real estate and public equities investing, as I personally have done quite a bit of this on my own as well. Let's first talk about real estate. Now, I've made a lot of real estate investments over my career, and so I feel like I come from this from like an area of knowledge and experience. There's this old saying, though, that I think about a lot, which is if you want to be a millionaire, invest in real estate. If you want to be a billionaire, invest in private companies. And the key there is that, billionaires, they invest in real estate to maintain wealth. It's a great asset class for maintaining wealth. It can be a really challenging asset class, though, if you want to build really big outsized returns throughout your career. And the reason for this is because you're really dependent on the appreciation of the asset plus the rent from the asset. Versus in a privately held company or in a company in general, if the company grows revenues, it can appreciate and value much, much faster than a piece of real estate can, all things being equal. But look, real estate is a massive investment sector with trillions of dollars of asset, and for good reasons. It's, like I said, it's the place where the billionaires are parking a lot of their money because it's a relatively safe and secure investment. But just like safe and secure carries with it little risk, where there's little risk, there's oftentimes less return that's available. I mean, real estate also has several other advantages, like because it's relatively low risk, you can typically borrow a lot of money in order to acquire real estate and really get leverage on your capital, which is helpful. And then also our US tax laws are really written in such a way that they really benefit real estate owners. But that still doesn't change the fact that you are effectively investing in a relatively safe and secure asset that's going to have capped upside. And so if you are really pushing for the outsized returns, you're going to find those more likely to occur in privately held companies. Now, there's also a lot of risk there too. The likelihood of you losing all of your money is also higher. So, just risk and reward, things to take into consideration when you're out there in your investment journey. Some of the downsides with real estate, though, is that as more and more people have seen real estate as a lucrative place to be investing, that has drawn more and more competition into the space. And that's made it really challenging to find really good deals. When I started doing real estate investing back in New York when I was growing up, there were a lot of really interesting deals to be had out there because not a lot of people were doing real estate investing. As time has gone on, more people have entered the market. That's really pushed up the valuations of these properties and made it more challenging to find really unique opportunities where you can generate a great return. The other thing is you don't have good credit or you don't have a good income stream. It can be really hard to qualify for loans. And the way that real estate is structured today, it's really challenging to buy pieces of real estate if you aren't able to get some type of bank financing to help you do it. I think about a lot of the people that are big real estate investors. There are lots of channels on YouTube and TikTok and so forth where they tout how amazing investing in real estate really is. But what they don't talk about is, they may have millions and millions of dollars sitting in real estate, but they don't talk about the millions of dollars that they have in debt and the chance and the potential that they could be turned upside down in these loans at any given moment and totally crater their investment. They also don't talk about like how challenging it can be to get access to that much credit to buy that much real estate. They don't talk about, the challenges of dealing with tenants who destroy your property, or the environmental issues that could pop up that could totally wipe out all the value in your real estate. Real estate investing is not without its risks, but as more people have entered the space, it can be more challenging to generate outsized returns. By contrast, let's talk about public equities. So lots of channels out there that talk about, how much money you can make by options trading and margin calls and investing in stocks. You got to invest in Tesla because it's going to be the next big thing, et cetera, et cetera. And look, public investing has some real advantages. Probably the biggest is liquidity. I can be in and out of a stock literally in under a second. There are high-speed trading firms that will be in and out of stocks within milliseconds. The liquidity side of public equities investing is great, right? If a stock starts tanking, you can sell and be out of it really quick, all things considered. You can also get really good diversification, right? You can invest in a mutual fund, for example, that for as little as like a few dollars will give you diversification across hundreds, if not thousands of businesses that are all trading on the public stock market. The issue though with this is that the liquidity and also the diversification bring its own problems. So you have lots of large hedge funds that will come in and play in the space through high frequency trading and other things that allow them to manipulate the market to their own gain. All of a sudden become super exposed to customer sentiment. If all of a sudden like people just don't like Tesla one day, the stock tanks and the next day they love it and it's back up again, even though the fundamentals of the business haven't changed at all. And so pretty soon, like investing in the public markets can feel like gambling. And in fact, in my opinion, it kind of is, because the only thing that's really going to change the price of a given asset is if there's a change in its true intrinsic value. Otherwise, these changes that you're seeing up and down are just going to be based on emotions and irrational fears that are going up. So what happens is on the day-to-day, you have these wild swings in stock prices because of some, general emotions that the market's feeling that day. And then when there is something that leads to a categorical change in the valuation of the business, like the fundamental intrinsic value, the stock market is designed specifically to make it really challenging to know what that is going to be ahead of time. And so the news just kind of comes out and the stock immediately adjusts to reflect that new increase in valuation. And so you don't know if it's going to happen ahead of time or not. It just kind of happens. And you get lucky, right, if you invested in the stock before that. Alternatively, the opposite could happen, and that there could be a massive wipeout of valuation because, the CEO got involved in some scandal, right? Well, the reality is that the hedge funds that are out there, they're pulling so much data on these companies that they're able to forecast these things far before your typical retail investor is able to see them, which ultimately makes it feel like you're gambling. There's this saying that I think about a lot, which is, if you're not at the table, you're on the table. The problem is that retail investors don't have the war chest of capital that some of these hedge funds have, or the data systems or what have you, to give them that slight edge. And so they end up being the ones that the hedge funds make money off of. They end up being the ones on the table that are getting carved up for other people's profits. So what's the alternative? Well, in my opinion, the alternative is privately held companies, and something that, historically has been really challenging for retail investors to be able to invest in and participate in, but that is increasingly becoming more and more available through a variety of different methods. For example, there have been laws that have passed that make it easier for non-accredited individuals, retail investors, to make investments into startups through equity crowdfunding on platforms like WeFunder and Republic and StartEngine and others. There are also other tools that have been launched or businesses that have been launched that give people access to investing in more growth stage deals and secondaries and private equity and so forth. Investing in private companies can represent a huge opportunity. And in fact, Harvard Endowment, which is one of the top performing endowments in the world, invests a whopping 30 to 34% of their total assets into privately held companies, whether it's private equity or venture capital or a variety of other ways in which they can invest directly into privately held companies. There are a bunch of compelling reasons to invest in privately held companies. For example, In many cases, you have a lot more influence and control. So if you're investing in an early stage company, you're investing a decent amount of money. The entrepreneurs that are running that company are going to listen to what you have to say, whereas you're not going to get that same kind of time and attention on the public markets. In some cases, you might even decide, hey, the way I want to invest in privately held companies is I want to buy a company, in which case you have ultimate control over the direction of that company, which, hopefully is a good thing because you actually know what you're doing. When you're managing and influencing those companies and helping them ultimately succeed. Another reason is that the returns can be higher. So if you think about when you should expect to see higher returns, it's when there are things that are inefficient in the market. That's one of the big reasons. Well, that's one of the hardest reasons with public equities investing is that so many people know so much about the company already that the price immediately adjusts anytime there's new information. In private equity investing, that's not necessarily the case. There are a lot fewer buyers. And so what you give up for liquidity, you get back in terms of, having unique insight and information into the company, which can result in better performance over time. A good example of this is actually Sequoia. So Sequoia is far and away one of the best performing venture funds out there. One of the things that's interesting that they do is that when a company of theirs goes public, they don't sell all the shares immediately like other venture funds do, because they look at it and say, I have this proprietary information about this company that I have gained over the last decade of being an investor in the company. And they leverage that to their advantage. In that case, it's not really insider trading because they've always been a part of the business, right? But it does give them a huge advantage. That same thing occurs all the time with private companies. You can find unique edges where you can gain, a unique perspective, information, etc. in these privately held companies and gain an advantage that doesn't really exist in the public sphere. The third one is diversification. So you can still achieve diversification across a wide range of different types of companies. So you can invest in early stage companies, you can invest in growth stage companies, you can invest in late stage companies, you can invest in companies that are generating high cash flows, steady, strong, consistent cash flows. Or you can decide, hey, I want to make a bet more on stock appreciation over time, and so I want to invest in companies that are growing really fast. You can invest across a wide range of sectors as well, just like you would in the public markets. And you can even invest in stuff that's more cutting edge, that's going to take a long time before it makes it to the public sphere. So you can capture some of the returns that exist for new breakout industries. For example, if you want to make a pure play AI bet, it doesn't exist on the public markets today for the most part. You have to invest in a Microsoft or a Google. But on the private side, there are a whole bunch of AI businesses out there that you could invest in that would give you exposure to the rising tide of AI and how it's impacting every part of our lives. You might be wondering, what are the different opportunities that exist for investing in privately held companies? Well, there are several good options. One, you could do angel investing. So investing at the very earliest stages of a company's life cycle, when they're just, a couple of people with an idea, all the way to building the product, launching the product, and getting their very first customers. You could do venture investing, which traditional venture investing is you're either investing in a fund or you're investing in companies that are generating kind of $1 to $2 million in revenue and really focused on growth. And included in venture is also investing in growth stage companies. So these are venture-backed companies that are growing really fast and looking to add more capital to fuel the growth fire. Those can be interesting opportunities. You could invest in private equity. In private equity, these are companies that are pretty well established. They may not be growing super fast, but they have very stable cash flows. Those cash flows are important because oftentimes private equity investors will use debt to buy these companies and use the cash flows from the business to pay down the debt. So you could participate in private equity, whether you invest in a private equity fund, an SPV, or buy the company yourself and use maybe an SBA loan to buy the company with your own capital. Another place where you could be investing is in secondary transactions. Now, secondary transactions are kind of similar to growth equity investments in that a lot of the companies that you would be investing behind or in are those companies, the growth companies, the late stage companies. The difference with secondary transactions is that instead of investing directly in the company, you're buying shares from another owner of shares in the business. So whether it's a founder, early employee, other investor that's looking to sell their stake, secondaries can be a really interesting place to invest. What's interesting about secondaries today is that you can buy into companies at massive discounts to where they last traded or last sold shares. I think there will be some incredible outcomes for investors that invest today in these secondaries if they can pick the secondaries correctly. The last bucket where you can invest in private companies is not through equity, but is actually through credit, through providing debt to these companies. So private credit represents a very large space where investors are providing debt financing to these companies. That could be all kinds of different things. It could be a leveraged buyout where a private equity firm is coming in and buying the company, and then lenders are providing debt financing to that company as part of that overall transaction of acquiring the business. It could also be like, imagine a scenario where the founder and primary owner of the business is getting older and decides to retire, and his or her lieutenants that have been running the business for the last several years want to take over the business. Private credit can be a mechanism wherein those managers can borrow money to buy out the prior owner of the business and then take over ownership and control moving forward. There are a lot of interesting ways in which private credit can be utilized, and in the current market environment where rates are really high, there are a lot of people moving into the private credit space to take advantage of the current returns that are there. The great thing about investing in private companies is that there are options regardless of what kind of investing you want to do or what your personal financial situation might be. There are opportunities if you are non-accredited. There are opportunities if you're accredited but don't have a tremendous amount of resources to invest. And there are opportunities for those that are accredited and have a lot of resources to invest. To help you on your journey of learning about privately held companies and what it takes to invest in them and what opportunities might be available, I've created a course that will walk you through the 5 different ways in which you can invest in privately held companies regardless of where you're coming from financially, whether you've got lots of money or a little money to start investing. Click on the link below and use the coupon code to get the discount you deserve for being a subscriber and watcher of my channel. Thanks.